one thing to remember is that China is 50% of global growth, and whilst the US might be 50% of global investing markets, the fact that China is 50% of global growth means that it is a serious and significant issue for the global markets. And also, let's not forget that even inside the US, there are some issues with Boeing. And again, if you listen to Steve Mnuchin, he's saying that that could be between 0.3 and 0.6% issue on growth for the US. So there we are. That's one issue in terms of what that does to the global markets. China is a major export market for South Korea, Australia, Russia, and on. So again, that slowdown is a big deal. The real point for the markets, however, is how long this is going to be. The markets always discount the future. They'll look at the future. So the big deal is there are three things when you think about the markets. Firstly, is it an exogenous hit, such as, say, a storm or something? Is it a one-off hit? We'll see. And remember, SARS effectively was a one-off hit. We'll see if this is a one-off hit. The second piece that is systemic issues, endogenous points within the markets. Again, we'll see how that works. But pandemics are somewhere in between. So if this lasts for a long while, it will become more systemic than exogenous. So we'll see how all that goes. But it's quite an interesting challenge. And again, we're looking at that very closely, and it's non-trivial. And again, the reality is it is actually going to be a serious point.
What we're also seeing is this now starting to be filtered into the Chinese economic growth forecast. It's filtering into the global economic growth forecast. What does that mean for markets moving forward? Do you think 2020 is going to be a risk-on move for equities?
Well, again, there's no question around the world we have stimulus. There is stimulus around the world from of the 33 OECD countries in 2019. 20 of them had stimulative process. They lowered rates, they did various other things to make it go. So I am very confident in the long term we are in a very, if you like, risk-on environment. No issue about that. The short term, however, on an idiosyncratic basis, it's very difficult to tell what will happen here. And remember, even last year when the S&P 500 did very, very well indeed, and remember, the S&P, probably about 30+% of their jobs are outside of the US anyway. But let's go back to the S&P 500 performance. Last year was 28%. The top quartile produced returns of 61%. The bottom quartile produced returns of 1 to 2%. So there's a very, if you like, dispersed market. So again, we'll see what happens in terms of overall risk on, if you like, activity. But look, it's a very interesting market. It's a market for active investors, for positive asset management. That's where that is, because again, we'll find a very interesting time.
So Michael, where's the opportunity in 2020? I know you're predominantly credit focused, but are there structural gaps or secular trends that you're leaning into that are shaping your investment strategy for 2020?
There are obviously always challenges, but I mean, remember, we are specifically, we are idiosyncratically focused. So of course, for us, we're looking through various things. Some currencies might be knocked around by the coronavirus. We're playing with those. There might be others which are moving around. There's a whole load of cross currents geopolitically and geoeconomically and frankly idiosyncratically that make us go forward. And again, in terms of any specific area, I still believe credit has got value. We're well into the credit cycle undoubtedly, but there is still value in the credit cycle if you choose correctly.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.